From a small town of Jabalpur to today having a corpus of 7 crore at the age of 35, what would be your advice in terms of investment?
Find your own recipe. All of what we get over the internet or through the podcast is ingredient. Understand your personal goals. Create your own recipe. Achieving fire numbers, it is really half of the story. The remaining half is
How did your investment grow along the way? And how did your investment strategy change across the years?
we always had a thumb rule. We will always keep our expenses in proportion to our needs, because while our income was growing exponentially, our expenses did not go at the same rate, and significant part of the income was getting into the investments.
Our audience is this 30 something who is on their way to financial freedom, building wealth. What would be your advice in terms of investment?
If you are somebody who can easily get influenced, then you have to reconsider before you actually plan to retire, because
Hi Kanha, welcome to Power of Money. From a small town of Jabalpur to today having a corpus of 7 crore at the age of 35, and on your way to being fired in the next 2-3 years, right? Your journey is not just inspirational, but also one of the most practical and relatable journeys I've seen so far. So let's get into it right away, and let's start with your early career and your early background.
like several IT professional, I started my career with a very modest salary of 20,000. It was startup where I started working, and then after a couple of years,
Which year was that?
it was 2012. I
Okay.
started my career, and after two and a half year, I changed the organization, and I could get a hike of 100%. I started working for IBM, and then after 2 years of experience, and I changed organization. I started working for Deloitte. Then in between, there was a startup. I feel yes, 3 years from Deloitte. Then again 100% hike, and then finally I started working for a product-based company. I'm working as a manager for Salesforce. So here also it's a very fortunately, because of the branch I could work for, the compensation was really great.
Got it. So, along the way, right, you said your salary grew from 20,000 to, whatever it is today. How did your investment grow along the way? Like, what was your first investment?
Okay.
Where did you invest? And how did your investment strategy change across the years?
So I started with fixed deposits. It sounds crazy, but fixed deposits at that time used to yield 10 to 11%.
Okay.
And gold bonds, and then property was something I was really fascinated towards to begin with. I remember I invested, I bought a piece of land for 40,000-50,000, but intention was never to get a huge return out of those investment. The intention was to learn the process, that what it takes to buy a property, manage it, own it, understanding the attributes around the same. You have to speak to the government official, you have to deal with the government related regulations and norms, how the true valuations stand, what is the selection criteria for a land which can basically, or real estate which can give you a good return. Similarly, not only real estate, but in equity, mutual funds, wherever you would like to pursue your investments opportunity as, you should always initially invest in order to learn.
Got it. And, Kanha, as we are talking about investment, right, I often see that as the salary progresses, right, there's this term lifestyle inflation. It creeps in, right? So how did you keep in check that while your salary was rising, you still invested, a substantial amount towards your investment? And how much were you investing back then, like as a proportion of your salary? And how much do you do today?
So we always had a thumb rule. I think when I started alone, as well as when I got married and I got a partner to this journey, that we will always keep our expenses in proportion to our needs, and what we actually need to be spending, variably adjusted against inflations or commitments. We never ever started spending in proportion with the compensation we have been growing up with, right?
Right.
So that certainly helped. I must have started. So Even to begin with, fortunately, the first job I started was in my hometown, so I could save almost every penny. So I was very habitual of investing at least 50% of my salary.
Okay.
Currently, I'm spending around 80%, which becomes, if I speak of myself, it is 2 lakh rupees a month. And somewhere similarly would be for my wife. We both heavily investing currently from past 2 years into mutual funds, equity and stocks. Until last year, I was her fund manager, but from last 1 year, my wife is taking care of her own funds. She's into steep loss, but I strongly feel that's a part of the learning, and she will, totally get through the journey. And that's how we are spending. But hers also a majority is into mutual funds and equity.
Got it. So as I think you were telling, 10 crore is the number that you have thought about, as your fire number, and of course you're on track for it. How did you come to that number?
I feel for anybody who is planning to get retired, $1 million is the right figure. For tier 1 cities, except Mumbai, it's too expensive. So $1 million probably for today's conversion rate would become 8.8 CR. And by the time I'll achieve this number, the conversion can go up to 100x. So by that sense, I kept it 10 CR. But the other calculation is also there, which is I've also received it from some of the information over the internet, and I found it so relatable that your 4% of the entire asset should be used as your annual expenses if you are planning to retire. So 10%, 4% of 10 CR becomes 40 lakh, which is pretty handsome amount to, if you cautiously spend in your day in, day out. And remaining amount, whatever the return you get, should be reinvested to not only continuously grow your capital, but also take care of the inflation.
Got it. And what about emergency fund and insurance? Like these are outside of the corpus, because you were mentioning you have a kid and everything. So how have you planned for that?
I have planned everything for that. So emergency fund, I think at least you should have in today's time or the inflation rate, you should somewhere around 25 to 50 lakh at least. But if you have medical insurance and if you have term insurance, half of the problem is taken care of. That is the first priority for anybody, it should be. And then once it is taken care of, you should have some emergency funds. Right? Not every disease or every challenge in life can be taken care by insurance. So you should have some emergency funds. Once these are taken care of, basis your personal commitments, every person is different, right? Yes. Every person responds to different challenges differently. So basis that, they can always recalculate their risk appetite for the instruments. So this is how I have set up my portfolio.
Got it. So let's go deeper into your portfolio, Kanha. Like, how did you construct it? So first of all, to start with, how does your 7-8 crore portfolio look like in terms of the asset allocation?
Right. So 60% of my overall portfolio is real estate.
Okay.
30% is mutual funds and stocks. Okay. And 10% is in gold bonds, cash or cash equivalents.
Interesting. And because you mentioned on liquidity, and a major part of your portfolio is in real estate. So is your real estate investment into like the actual houses from which you can derive rent?
So yes, I have in flats, I have in houses, the independent house in my hometown, which is Jabalpur. It's again a tier 2 city. And then I have agricultural land as well. I have commercial land as well.
Okay.
And I have plot where I feel that which is bring up good yield in near future, and I'll probably trade off that with a new venture or something if I find better. So and rental income is always there for me. I've always leaned on to a rental income along with the fixed deposit returns or anything else.
Okay, so there's rental income on the commercial and residential land as well.
Yes.
Okay. So you mentioned a house in your hometown, Jabalpur. You mentioned a residential land, a commercial land, and another plot.
Yeah.
My question is, how were you able to finance all of this? You were telling about home loan and all of that.
Yeah.
Tell me more.
Right. So I'll give you a calculation, very, very nice calculation that I had long back. Let's take an example. If you have taken a house for 50 lakh rupees with loan, right? The rate of interest 8%, fluctuating 0.5 here and there. Okay. and you have 50 lakh rupees worth of house. Down the line, after 30 years, you will end up paying 1.3 to 1.5 CR somewhere near. While your asset, even if it grows by only 8%, real estate asset will become 3 to 4 CR, or at least 4 to 5 CR. Correct. The reason is that this is on depreciating capital, right? Sounds crazy that you are buying and appreciating at the same rate. But since home loan are in a depreciating asset, and your real estate is a appreciating compounding. It's compounding is happening on the appreciation you're receiving from the property. That is why down the line the gap is significant. And I remember in 2021 where I actually changed gear, shift gear. I started pumping in all my money. I thought of taking a pause from real estate because of cashifying factor, what you're speaking of, since we started this conversation. I realized that by that time I had a good amount of loan. And
how much was that, if I may ask?
It must be around 30-40 lakhs, right? Now for me to, I used to hastily repay the loan. I'll get and I'll take the loan, I'll purchase the property, and then the main target, I'll be start chasing to repay the loan like anything. I hastily used to repay the loan. Then I realized the idea is not to be debt free. The idea is to be wealthy. I have to crack the code. So what I have done, I have sort of worked on a framework where what I do. So let's say, for sake of easy example, I have a loan of 15 lakh rupees. Okay. Now I have an option. Let's say if I want to repay with 5 lakh rupees of repayment, what I have received this year. I will create a buffer account and I will fund it enough so that my next 1.5 year of EMIs will be deducted. I know certainly it's a stretch, but this stretch will help you save your cash which you're going to pay off against your loan, but also will help you create a corpus from that 5 lakh rupees which you have saved. So now what I would do, those 5 lakh rupees would be invested in a mutual fund where why I'm saying buffer is required, because like I told, mutual funds can take a year or two to give you the right yield, right? So after 1 or 2 years, when I have the right returns or the market is high, I will take some money out from it. I'll dump it and refill my buffer account, and I'll continue doing that. In ideal state, so had I paid that loan with 5 lakh rupees, my EMI would have been down by 3,000-4,000. The same 3,000-4,000 I'm receiving from mutual funds. So for me, look at the setup. I have a real estate which I'm owning, which is growing at 8%, right? I have a peace of mind because I have a collateral available.
Right.
In case something happens, I can just pay off my entire loan. At the same time, I have a mutual fund, which is growing at the higher rate at which, compared to which I'm repaying the loan.
Right.
So at end of the day, I'm going to gain and make, part of the wealth together.
Right.
So that's what I'm operating since then.
Got it. So you actually used the concept of leverage very well.
Yes,
you actually used your money to invest while
Correct.
leveraging on the bank's money.
Like I told, e-margin for
Yes,
trader, no?
yes, absolutely. So I think a interesting and a very important thing in all of this calculation is your real estate also appreciating, with the inflation or even more. And for that, I have seen there's a lot of research and study that goes into selecting the right piece of land. And I'm sure you would have done your research before doing real estate, because you are investing a big amount for a really long term. So tell me, what's your framework for, selecting a piece of land?
I think one catch with real estate, research is that it is highly dependent, and that is why we don't have a generic structure what we have for mutual funds or the generic strategy. It highly depend on which city are you in, where actually buying the land, what kind of land are you buying, what is the purpose of land. So and diversification is very important. For example, agricultural land really boomed in last 5 to 10 years. I'm telling you, the land which I have purchased was somewhere around 10 to 15 lakh rupees a acre. Now it is probably at least, if not 10 times, must be 7 to 8 times.
Wow.
Correct. So and second thing, when it comes to identifying property, I never invested where everything is already developed. So it is as important as or as relatable as you purchase a stock, right? You should know your entry point and exit point.
Correct.
People at times, even if they know the entry point, they don't know the exit point. Speaking of the flat, people say flat is just a liability. Certainly, if you don't operate it smartly, there are many builders who are giving you projects at very subsidized, not subsidized, at a discounted rate when the project starts. Even the tier 1 builders, I'm speaking all over the tier 1 cities. And once the launch happens, handover happens, within 2 to 3 years, the appreciation happens like 10 to 12%. That's a record. If you'll speak of Brigade or all the famous names of builders in Hyderabad or Bengaluru. But people hold on to that investment too long that it start getting saturated. That is why they relate कि यार 15 years में तो फ्लैट का बढ़ा ही नहीं. Flat got a cycle. 10 साल पुराना फ्लैट कोई नहीं लेगा. 3-4 साल पुराना is something which is considered to be new. People will buy it.
Right.
So in every variety of the real estate, your mindset should be different.
So have you flipped property?
Yeah, absolutely.
Okay.
That is how you're able to grow, right?
Okay. So how after the 3-4 year period you typically flip?
Yes. Real estate certainly takes 3 to 4 years, 5 years. At times, I have been observant to see that, okay, there's a flowers going to be constructed nearby. So I know the traffic will be from this side. So appreciation will certainly go up.
Yeah. So coming to mutual fund, right? I think that you have around 30% of your corpus in mutual funds.
Right.
So what's your split across large, mid, small cap? Do you have a strategy there? How did you build your mutual fund corpus?
Okay. Looking at my risk positioning as of today, I have, because I don't have any upfront commitments, I have taken care of the fundamentals. Now I know that I am able to take a certain amount of risk. So my portfolio split is, for at least next 5 years, it's going to be 60% high risk.
Okay.
Small cap, sectorial. Even in small cap, I make sure that when I'm choosing either the themes, I use a lot of common sense. I do a basic research that while let's infrastructure is going up, the EV infrastructure is going up, what all the companies are in play? Equity is something would require very, very active efforts. It's something I cannot pick. So I go for mutual funds, something relatable. If I find, I'll go about it. And I also make sure that ultimately all the fund houses shouldn't be investing into the same set of companies, right? I always take care of, I always check their individual portfolios where actually the money going in. And this is how I select. I take a lot of, risk and experiment over there. Then it comes to, medium risk, where I have balanced advantage funds.
Okay.
I have mid to large cap funds, which are known stable funds. And 10% is where I have depth funds, which will give me a steady 7 to 8% at least.
Got it. And within these categories, right, the high risk, small sectoral, medium is the large and mid, and the debt. Do you also have a framework for selecting the mutual funds? Because there are thousands of mutual funds out there.
Yeah, certainly. See, when it comes to it, I do fundamental, because for anyone who is looking at a long-term benefit, fundamental takes the precedence over the technical. Technical is good for people who are trading in short-term, RSI, breakout, resistance, and all of it. But fundamental strong, I check their balance sheet, their expense ratio, their profit ratio, profit margins, how they're operating, what is their quarterly results. So I keep a tap on that, especially if I have invested a significant amount of money. Even in equity, apart from checking the fundamentals, one thing I always do, I research. So fundamental is what piece, what are they doing? It's also important in Indian consumer segment, that how are you doing it? Correct. The example is that how ethical are they? Are they there in the news? What are the sentiments around those organizations? Very good example you must have seen in Ola. There's a Twitter tweet. There's a tweet in the Twitter and everything. In very next day, the stock took a 10% of dent. So in long run, I always keep a check what are the positive and negative news around the same, who's taking over, what company. So that helps me. This is active engagement, right?
Right.
So this is how I select. Otherwise, I don't go for anything out of the box. It's all what is available for us, and most often than not that works.
Got it.
Yeah.
So you mentioned around the quarterly results and all of that. So do you, because you invest in mutual funds, do you look at the underlying stocks and like do that research? Like
Yes, absolutely.
Okay.
Ultimately, because even if you invest in 5 stocks, if I invest in example blue chip funds, trust me, 30-40% allocation of all the blue chip funds, be it Kotak or be it HDFC or Nippon, 30-40 organizations are the same. So so indirectly you are investing a huge amount of money into those funds, right, or those companies, and that gives the reflection of how this mutual fund is going to do.
Right.
So that is something I do, and one thing I have been, uh, I think personally following that, I abstain from investing huge in technology companies
Okay.
or app-based organizations like Zomato or Swiggy. What I personally feel good for short term, but it's easy for them to have competitor in no time. Whereas any investments, any organization will take a lot of capital to get into the market, or the regulation is very complex, licensing is very complex. Pharmaceuticals, nobody can simply start making paracetamol in a day or two, right? Or manufacturing, it takes a lot of expenses to set up the industries and all of it. So those kind of funds for longer run, I have been giving good yield to me, and
Okay.
with minimum intervention, so I prefer those.
So, Kanha, as we were discussing about the portfolio, right? Your mutual fund portfolio has a 60% exposure to high risk and then 30% to medium risk. Was it always like that? And do you plan to like sort of change it along the years? What's your plan?
So as per my today's risk appetite, I am keeping it as is, like I told. But down the line, certainly I don't want to expose my portfolio to this much of risk, and I'll probably lean over more on consistent returns.
Okay.
Right? So every 5 year, I plan to bring down my high risk to by 10%. That means down the line 5 years, it will become 50%, and we'll split it back to medium to low risk funds. Right? I'll continue doing that until when I reach near my 60s, where I'll be, really looking for stability rather than building a big corpus. I would switch over to medium or probably lower risk funds. That's what I'm thinking. But in midway, if I happen to see that basis how the journey, how the future, lies over there, I may lift and shift. This is how small funds are performing, mid-size, mid or balanced advantage funds. What I've invested within that category is performing.
Got it, got it. And one of the things that we see in a lot of people we speak to and even our customers is that usually in mutual funds you start an SIP and then you end up staying invested in that mutual fund for the rest of your life.
Correct.
Does that happen with you, or often rebalance? How does
Yes, I always keep a check how a fund is doing across the category or within the category at least. And I'll always keep rebalancing. And top of that, what I personally do, I have analyzed last 15 years of data.
Okay.
That is again with the help of AI and all the tools available. And I found there's a pattern that every year for a few months, the market goes up and goes down. And that give you a prediction with 78% accuracy, which is a great prediction. So now let's say if I'm investing 2 lakh rupees for SIP every month, or I have allocated that, I would let only 50,000 go through the monthly SIP, whereas 1,50,000 I will hold on until I see the market is going down or the market is going up. So going up, then I'll hold of those funds, and as soon as it is down, I'll just pump in all the money. So this is what I've been doing, and this small manipulation or tweak is giving me 3 to 4% extra on the same fund, correct? And market in an year, you cannot predict the true bottom and true peak, obviously.
Correct.
But you can always know that how many times it has went plus 5%, minus 5%. So as in when it is plus 5%, you just hold off your SIP, probably let a part of it go naturally, or as is. Whereas whatever you have, held to be reinvested or invested, do as in when the market dips below 5%.
Got
So
it.
that I have been doing from past 1 or 2 years, and for the same mutual funds where people are yielding 11-12%, I'm getting 16-17%.
Just because you were
Yeah.
able to time it a
Yeah.
little better. So did you start SIPs after you did the real estate, or did you started when you were, from your first salary?
Like I told, I started because I was very I was driving a lot of suspicion that how the market would behave. We did not have much information. We did not have validated information. At least it was all in bits and pieces. So I was very, very apprehensive about the strategy of investing a large amount in SIPs and mutual fund. So but though I started with 2000.
When was that?
It was in 2012, and like I
Well.
told, it is already there still. I'm not going to dissolve that. So it is, and until 2019, 2020, I was only investing in real estate
Okay.
heavily. And though I had a few stocks, few mutual funds, but very limited, insignificant in terms of the kind of portfolio I had. But from 2021, when I understand the cashifying factor and I thought of switching over to secondary income as my primary income, I started pumping money only in mutual funds. So for 4 years, my every penny, unless the bonus or there's something I really to take care of in real estate,
Okay.
I invest in mutual funds.
So you missed the COVID dip of
Yeah, COVID dip, yes, a realization or understanding that the liquidity matters a lot, right? As in when you are looking at your comprehensive portfolio, correct, and leaning on to that such a huge amount, having money in your portfolio and actually getting it when you need it is a different factor.
Yeah.
So that is why I thought of rebalancing both the
Right.
aspects.
Right. So I think your portfolio is a very good diversified balance of, real estate, like hard assets. There's mutual funds. Even in that, there's high risk and, safer funds as well. So at such a blended level, what is the kind of returns that you are making year on year?
So my, if you speak last 2 years, my CAGR had been 11 to 12%. Again, I'll consider the market ups and downs, but it went up to 20% as well, right? So it is pretty decent, and I'm beating the inflation and getting some space out of the entire yield to reinvest.
Got it. So I think after the portfolio, right, and after achieving financial freedom, right, what's your plan? Like, do you have a strategy? Do you plan to do SWP, or you plan to continue to work? What's your plan?
Right, I mean, I am keeping all the options open, and that's the beauty of it, na. मतलब जो चाहूँगा वो करूँगा वाला है. But yeah, even if I work for the same salary and same like work or same role, imagine the kind of confidence I'll carry to my workplace.
True.
Right? Because I'm not bothered what happens to my role tomorrow or what happens to my job. So I really wanted to redefine this FIRE thing. Not necessarily you leave your job, but getting rid of that mental burden. It itself is a true liberty and freedom. But yes, I am leaning on heavily on SWP.
Okay.
Right. Because rental yield is one area, whereas SWP and mutual fund should be one of the pillar for me to withdraw money and meet my expenses.
Right.
Like I told, SWP doesn't mean, so rather I personally feel should be strategic withdrawal plan than a systematic withdrawal plan, because you cannot simply withdraw money every month. If you do so, when the markets are down, you will start denting your capital.
Right.
Correct. So it's very important you create a buffer. So I feel that I should have a working capital of 2 years, which can meet my annual expenses. And 2 years is something where in duration, as in when the market goes up, I'll withdraw the money, and when market is down, do not withdraw a single penny. That's only this SW is going to work. If we feel that simply like SIP will start withdrawing the money,
Okay.
I don't think that would be a great idea.
So have you like planned for, because you have two sources of passive income, one would be SWB and second is the rental. So do you plan for your main chunk of expenses being taken care of by rent, because that's more steady?
No, I'm leaning on to both, because when I say I will have 10 year of portfolio and mix of both. So I would like to have the majority of the expenses should be met, but real estate also comes with certain liabilities, right? The maintenance cost, and not necessarily will have tenant every month, correct? So if I'm retiring, my plan should be foolproof, correct? If not this, then other functions should continue to work, like two engines in a plate. So that's the expectations I have with both the setups.
Right. No, I think great and very practical, relatable investment journey you have had. So thanks for sharing that. So I think, and we'll end the podcast on this note. Our audience is this 30-something who is on their way to financial freedom, building wealth. What would be your advice to them in terms of investment and, the life ahead?
First advice would be diversify a portfolio. Don't over diversify, but initially diversify because you don't know what works for you well. Once you identify this works for you well, and then you can encash on those options, be it mutual funds, equity, stocks, or standard bonds. Second, find your own recipe. All of what we get over the internet or through the podcast is ingredient. Understand your personal goals, personal life, personal commitment. Create your own recipe, right? What you really want in life. What is your risk appetite, and what is your financial goals as a family. So that is really important. Third is achieving FIRE number is certainly a bigger task, but it is really half of the story. The remaining half is you actually building a framework where you are able to replace your monthly salary, because many of the people actually withdraw the moment even if they are able to get that FIRE number, they are not able to commit to those numbers they have initially planned because of inflation or change in plans or change in commitments. So you have to work on the framework which will consistently give you the money. Last but not the least, very important is the psychology behind and mindset behind all of it. If you are somebody who can easily get influenced, then you have to reconsider before you actually plan to retire, because you won't be able to commit to a single number. If I have never been impulsive buyer, but I have kept a cap to it, 40,000-50,000, not beyond that. But I haven't been impulsive buyer just because I can buy a 50 lakh rupees of car and end up buying that. Because over the year, as your compensations grow, you end up getting access to the society or the privileges or the group where you now start feeling societal pressure. You naturally feel that you need to upgrade just to cope up or meet up the requirements. I never felt, or let's say it certainly took a conscious efforts for me to build myself such a way that if I need to get retired, because if I retired, my friends still might be earning higher than what I would be getting from a passive income. Correct? So I have to immune to all of it. If our mindset is not ready, as a family it is not ready, if we understand our needs and we pursue our desires in a planned manner, it is a goal for me. Else I suggest, because leaving job is an easy decision, but you have to plan through it.
Correct.
So that's the only message I have, but it is real. It is really achievable. If I can do it, anybody can do it with the right strategy and consistency. So that's all I can pass on to the audience.
Perfect. I think perfect note to end this conversation, Kanha. And the last point you mentioned, right? I think it's extremely important, because I feel like money is less about numbers, more about emotion. So that is the most important. And thank you so much for sharing your journey from a town in like Madhya Pradesh to today, planning your financial freedom journey, right? I think it's super inspirational, and I hope people watching this podcast will get inspired.
Thank you. It was all my pleasure.